Futures higher on a flurry of headlines. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, President Trump wants to scrap quarterly earnings reports, a move that could create a tectonic shift in U.S. equity markets. The president also says he'll speak with Xi Jinping on Friday as China raises trade tensions by investigating Nvidia. And go big or go home. President Trump predicts a hefty cut from the Fed as officials juggle a high-stakes moment for the U.S. economy. Dani, what are you watching?
Well, it's a fire hose of news, of headlines this morning, and this one came around 6 a.m. Shares of Tesla are higher after regulatory filings showed CEO Elon Musk purchased about $1 billion worth of the carmaker shares. Those shares go up by 8%, and Matt follows on that $1 trillion pay package that they announced for Musk.
All right, so one big move in the Mag 7. I've got another one. Nvidia shares are falling after China ruled that the company violated anti-monopoly laws back in 2020 when it acquired Mellanox Technologies. China also says it's launching an anti-dumping investigation targeting a type of chip made by U.S. companies, including Texas Instruments. But Nvidia shares right now down just about 1%. They had been off more earlier in the pre-market. TI down more than 3%, Dani.
Let's go back to our top story this morning, Matt, and it is President Trump saying that companies should not be forced to report quarterly earnings. The president took to Truth Social to say firms reporting on a half-yearly basis would, quote, save money and allow managers to focus properly on running their companies. For more, we are joined by Bloomberg Intelligence senior government analyst Nathan Dean. Nathan, it's something Trump flirted with in 2018. How likely would this be to get through to the SEC, and what kind of big changes would it mean?
So I think it's actually somewhat likely, but I would say I don't think it's going to happen by 2027, because like you said, this is something that occurred before back in 2018. And the market participants' reaction to this was somewhat mixed. Investors were like, look, we want this data, but companies were also saying, well, there potentially could be some capital formation positives for this idea of long-term investing. So I think what the SEC will do here is they'll say, certainly, President Trump, we are going to look into this. But it's not like I don't think they've actually written a rule or anything like this. So I think they're going to go back, and either two scenarios will emerge. They're going to either do another request for comment, or they'll put out what's known as an advanced notice of proposed rulemaking, both of those occurring probably in the first half of next year. And then they'll go through and they'll try and find out more consensus of whether or not this is something the market wants, or is this something that the capital formation folks need. So I don't think it's going to happen by 2027. I'm sorry, I don't think it's going to happen anytime soon, but certainly by 2027, this could be a reality for the market.
Nathan, has the president been using executive orders as much recently, and can he change regulations in that way?
So, the way that President Trump is using executive orders in the regulatory sense is just a fancy way of picking up the phone and saying to his agency leaders, saying, I want you to do this. And so if President Trump orders the SEC chairman to do this, even though the SEC is an independent agency, we don't think the SEC is going to be in the business of telling the White House no. So I do think what will happen is somewhat similar to what happened in 2018 when President Trump floated this with former SEC Chairman Jay Clayton, is Jay Clayton came out and said, right, we'll do a request for comment and we'll kickstart the process. And I certainly think that Chairman Atkins would do the same here. The one caveat is that when that happened, the SEC ran out of time. In this case, it's early enough in the 4 years or the 3 years we have left that the SEC certainly can't do something before the end of the Trump administration.
All right, Nathan, thanks very much for that roundup. Nathan Dean there of Bloomberg Intelligence, for some reason known as America's dad. I can't remember exactly why, but that's Joe Matthew.
I felt comforted listening to him.
He's not wearing his vest. Sometimes he wears apparently a fleece vest and resembles America's dad somehow. Turning to tech, Elon Musk purchased about $1 billion in Tesla stock on Friday. He made the move after Tesla's chair spoke with Bloomberg Tech's Ed Ludlow about the merits of a potential $1 trillion pay package for Musk.
The board's responsibility is to look at who the CEO is for the next period of time. And we believe that Elon is the right CEO for Tesla over this transformative period of time. And our view is he's a generational leader. There aren't any other people out there like Elon.
Let's get straight to Bloomberg Tech's Ed Ludlow. Ed, again, the timing interesting here. What was the decision, and why do we think Elon Musk did this?
Yeah, I mean, the market's seeing it as a really positive signal that Musk from the other side of the negotiating table is saying, yeah, I kind of buy what Robin Denholm's saying, like I'm feeling positive about this, you're feeling positive about this. It's the first time that Musk has bought stock on the open market, but I'd note he did it through a revocable trust, and he did it on September 12th. The same day as that conversation, the first time since the beginning of 2020. Remember, in 2022, he was a net seller of about $20 billion worth of shares, but that was the year that he acquired Twitter, now known as X, and he needed the capital and the cash. So there's a long way to go on this still. Remember that shareholders will vote on that package on November 6th. And it was really difficult on that conversation Friday. And actually, I've kept phoning investors to get a sense of where they sit on it, because it's not universal that they feel that the structure of it, the way that Elon is required to hit mandatory targets, is a good thing or not.
Ed, we know that the U.S. and China are having talks around TikTok in Madrid right now. President Trump is going to meet, reportedly, President Xi at the end of the week. The Chinese have opened an investigation into Nvidia. What is it on? Where does it stand? And how damaging could this be to the U.S. chip maker?
Yep, it's on Nvidia's 2020 purchase of Mellanox Technologies, which in the data center context focused on networking. So think basically like Ethernet cables that tie all the stuff together. It's a story about timing, right? And the Treasury Secretary noting that the unhelpful nature of the timing, it reinforces that Nvidia, in more than one investigation and domain, is kind of at the heart of these negotiations. Remember that more casually, Chinese regulators are advising tech companies in China not to buy Nvidia's H20 chip, even though on the American side, they're now authorized to do so, or at least able to apply for licenses. So it's a historic investigation. The timing, therefore, a little bit interesting. But based on the headlines of this morning, both out of Madrid and from the president on the social media space, things seem to be progressing.
As we're talking about headlines of this morning, Ed, less than 30 minutes ago, we got Bessent telling reporters that a framework for a TikTok deal had been reached. Trump seemingly putting on Truth Social, something along those lines as well.
Yep. So the Treasury Secretary says a framework has been reached. The president is going to speak with President Xi on Friday. I would note that Oracle shares in the pre-market made a move higher. The context being that there is a deadline this week for the divestment of the U.S. portion of TikTok. And historically, in the short term, this administration has been open-minded to the idea, at least in its public communications, that they would let the U.S. entity of TikTok die. But the president's post on Truth Social, the idea that he references young people wanting to keep it alive, makes a lot of sense. We don't know anything other than that. The market response, reading between the lines of Bessent and the president's statement, would suggest that that bidding group, the consortium, which it basically included friends and associates of the president's family, Oracle, as well as the data warehousing side of it, that might be what we get, but we just don't know.
Ed, thank you very much. Got to save it for the kids. Bloomberg Tech's Ed Ludlow, and you should, of course, watch his show at 11 a.m. Eastern. Now, investors this morning also waiting the Fed decision on Wednesday. President Trump pushing the central bank to go big this week.
The Fed chairman's incompetent. I think you have a big cut because I don't think he can help with cutting. It's perfect for cutting.
Michael McKee, Bloomberg Chief Economics and Policy Correspondent, joins us now. Mike, Trump expecting a big cut. What are markets expecting?
Markets are not expecting a big cut, and the president is likely to be disappointed. However, he is likely to get a cut. It is going to be a very busy week. Today we had Empire Manufacturing post a big loss, suggesting the economy is slowing down significantly, and that could mean more evidence for the Fed to cut rates. But they're already on track. Tuesday, retail sales and import prices will give us an idea of whether consumers are hanging in there and whether foreign exporters are cutting their prices to absorb some of the tariffs. Wednesday is the big meeting, of course, and Thursday, jobless claims in Philly Fed. They could be influential, but the Fed will have already met, so probably not going to matter quite as much. Before we get to Wednesday, though, we've got a lot going on. The appeals court may decide today on whether Lisa Cook can be part of the Fed when the meeting starts tomorrow. The administration has asked for a decision by today. They don't have to, but we could get a decision tonight. And of course, also tonight, the Senate likely to confirm Stephen Myron to the Fed. The Fed meeting begins at 9 a.m. on Tuesday. The decision at 2 p.m. Will there be a cut? Will there be dissents? Plus economic forecasts and the dot plot. Got to stay tuned for that.
I know the Fed is looking closely at the jobs data, and that's why they'll cut. But inflation is still relatively high, right? It's still 50% above their 2% target. 2.9% is the headline number. 3.1% is the core CPI number. President Trump says, first of all, that inflation is gone and it's come down on groceries. But he says housing is the main sticking point. That's the big problem. And he thinks this cut is going to help somehow with housing. How does that work? How does that look to you?
It looks iffy. We're not sure what will happen with housing. But first of all, grocery prices are going back up again, which the president kind of left out of his statement. But with housing, it's the long end that matters because that influences mortgage rates. And the long end has not been, as you know, behaving the same way as the short end. The Fed is the influence for 2 years and shorter. And after that, you start to get into what investors think inflation expectations are going to be. So if inflation is still going up, then we may not see long end rates come down, which may mean you don't see mortgage rates come down. So it's hard to say exactly what's going to happen. It's not a one-for-one correlation.
Well, I know the last time the Fed cut, we had the 10-year actually rise. Mm-hmm. But if we got the long end down and mortgage rates are lower, house prices, I assume, would go higher.
Right, because all of a sudden the people who were locked in their mortgages that didn't want to move might start to move if you get enough cuts, and then there's more demand, and then prices are higher.
Yeah, it's going to be very interesting to watch. Michael McKee, this is your wheelhouse. This is your ball of yarn. Mike McKee is our international policy and economics correspondent. Let's get a check on futures right now. We are just 20 minutes away from the opening bell, and we do see gains here on the S&P futures, 0.3%, a little bit less on NASDAQ futures as Nvidia shares are so heavily weighted there, and the small caps are rallying the most, I guess, ahead of this cut.
Yeah, small caps, there's been a lot of calls for small caps. Matt, I think the thing today is bad news is good news is good, no news is good, and literally this fire hose of news we've gotten apparently is also good this morning, too.
Absolute ton of headlines this morning.
Many headlines. We have another one for you. Coming up, United Health is said to be stepping up its lobbying of Trump allies. We're going to bring you that story next. You're watching Bloomberg Open Interest.
Let's get now to high interest. Look what's making headlines around the world. New York Governor Kathy Hochul is endorsing Democratic nominee Zohran Mamdani for mayor of New York City. It's a key affirmation for the frontrunner whose candidacy hasn't yet been fully embraced by his own party. And the decision is as well a blow to incumbent Mayor Eric Adams and to former Governor Andrew Cuomo, both of whom are running against Mamdani in the general election. Barclays is preparing to spend at least $1 billion to renovate its skyscraper here in New York City's Times Square, becoming the latest financial giant to invest in updating its office space in this city, even though Mamdani is in the lead. Construction will begin in the middle of next year, with the project expected to wrap up in 2030. And United Health has tried to schedule meetings with President Donald Trump, although it has not yet secured one, according to the Wall Street Journal. The attempts are said to be part of an increasing lobbying effort by the health insurer as it faces a number of regulatory challenges. United Health has been grappling with high costs and federal investigations, including a criminal probe into its Medicare billing practices, which has pushed its share price down about 30% so far this year to date. Dani?
Yeah, it's been a company that's been struggling, and let's get more on that story. Shelley Banjo, Bloomberg's managing editor for global business, joins us now. Shelley, this is a company that also seemingly secured meetings with Susie Wiles, so with Trump allies. How unusual is it? Because this is a company that is highly, highly exposed to U.S. regulation.
Yeah, United Health has been dealing with quite a lot this year. I mean, from the civil, the criminal suits, the death of their unit head, the new CEO, the stock, you name it, it has happened to United Health. And they're, spending big in Washington to try to have a seat at the table, and they're not really shying away from that. They told investors, this is what it takes right now to be able to have a seat at the table, to be part of this conversation, and they're going to pay up to do that.
So I guess your first order of business would be to hire Trump-adjacent lobbyists, and then you try somehow to give Trump as much money as you can.
Yeah.
What have they been doing?
Yeah, well, so we started looking into this across actually all the companies in the S&P 500. This is part of the Trump playbook right now. If you're running a company, you want to hire the MAGA-affiliated lobbying firms, folks who have been in and out of the Trump administration, either 1.0 or now. And a lot of companies are doing this, and they're finding that those connections really go a long way.
It's a different degree. I understand that because you do have Trump who's been directly involved in American companies. But isn't this a playbook regardless of who's in the White House? You want to be lobbying the White House. You want to be lobbying D.C.
Yeah, you definitely, that's always been the case. You're always, having a relationship with these folks. But we've been talking to CEOs across the board over the last few weeks. They're adding more people in D.C. They're getting more directed, targeted meetings. They're being very careful with which lobbyists they choose. So you're right. It's always been the case, but I think it requires tweaking here and there for the Trump presidency.
And they've had, serious issues all year, as you mentioned, the assassination of a unit head, a lot of, mistrust on the part of the public, right, in terms of their business model. Have they addressed that, how they're operating as a health insurer?
Yeah, I don't think there are few companies that have more at stake right now in front of the Trump presidency than United Health. They've got civil and criminal probes going on. They have this sort of issues that they've been having with the American public. How much are we going to be spending for healthcare? Things like prior authorization that get people really, really ramped up about it. And so, we have to convince the American people as well as the Trump presidency that they should, be able to keep going with their business practices.
I know one of the issues also is in payments that they have for their various Medicare businesses too. It's been something this entire industry though has been grappling with, right?
Yeah, and they were hit pretty badly. They're starting to, try to figure out what does all of this mean for them now with all the cuts and all the hits to Medicare, and that's part of the ongoing conversation that's happening right now.
All right, Shelley, thanks very much for covering this with us. Shelley Banjo is in charge of company news coverage here at Bloomberg. Let's get a check of futures ahead of the opening bell. We're looking at gains here, 0.3% still on S&P futures. NASDAQ futures down a little, or not up quite as much because of the drop in Nvidia. It's only 1%, but it's a very heavy stock. And then the small caps up 0.4. Coming up, Marija Veitmane joins us from State Street to discuss why she thinks some equity investors are holding a misguided view of the markets. This is Bloomberg Open Interest.
Top Wall Street strategists are boosting their S&P 500 targets, with stocks holding near all-time highs. We're set to hit another one today. Morgan Stanley reiterated its bull case for the S&P 500 to rally to 7,200 by mid-next year. Infrastructure Capital looking at 7,000 by year-end. RBC also now expects the benchmark to end the year around a lower number, but it is higher than what Lori Calvasina had before, 6,350. Let's get State Street's view with head of equity research, Marija Veitmane. Marija, great to see you this morning. You talk about this, that this is an idea, the idea that this is an environment where the perception is that equity investors can't lose. You say that idea is misguided. Why?
Yeah, first of all, absolutely agree with all my colleagues about strong equity market outlook. Hey, we have a world where strong data, great for earnings, weak data, great for rate cuts, stocks rally. We have volatility is not being huge. Investors are joining in the rally. Everything looks great. However, the problem I see with this thesis is that the idea of earnings being great. Earnings are great in only one place, and it's tech. And it's fantastic. It's the largest sector. It's pulling everything higher. But in terms of your allocation within stocks, it's just tech and everything else. So that's the trade for us. It's kind of a relative preference, which is very, very strong. But the problem for investors, of course, is that everybody are crowded in tech. It's very expensive, so it's a difficult trade. We still think it's a right trade to kind of push Max 7s, but it's a challenging trade.
Why do you think it's only the tech stocks that have institutional ownership, and it's only the tech stocks that'll continue to drive this rally? We were talking with Katrina Dudley a couple trading days ago, and she said she expects a rotation. So she's taking profits from those Mag 7 stocks and buying the S&P 493.
Well, Matt, that's been conversation I had with investors for the last 2 years. Everybody wants to sell out of tech. And I would be the one as well, when and only when we see broader earnings growth. If I look at earnings expectations right now, I mean, tech is what, like good 20% for this year. The rest of the market, a quarter of it at best. That's the problem I see. So for me to have a broadening of earnings to rotation or broadening of stock return, rotation out of tech, you do absolutely need to see better earnings story. And until then, it's still Tina. Investors, I mean, they get on the risk of day, you get spooked, you sell big tech because it's expensive and crowded. And then what do you buy? And that's the problem. You need to buy something with good earnings, and you don't find it, and investors go back into tech. That's the story.
What if we get this rate cut this week and we get consecutive rate cuts? Is that enough for a bigger rotation?
I think that would be kind of the first step. But I mean, you do need to see earnings growth expectations. You do need to see earnings recovery. And so far, we are really not seeing it. And I mean, a lot of it, I guess, is to do with kind of the shape of the curve. And we need to see longer end to come down. But yes, rate cuts kind of the first step in the right direction.
All right, Marija, you're going to stick with us. We have to get more time with you on the other side of this break. State Street's Marija Veitmane is still bullish on stocks, and we do see futures higher ahead of the opening bell. We didn't quite hit an all-time closing high on Friday. I think the market closed at 66.84, and we need to get to 65.84. We need to get 65.87 for a closing high. I'm going to double check that on my handy Bloomberg terminal. But we are headed in that direction again.
And the NASDAQ got there. And as a matter of fact, if it closes higher today, it would be the 9th straight day of gains, which would make it the longest winning streak since November of 2023. We have your open for you coming up next.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller, looking at solid gains on futures, 0.3% on the S&P 500 and the NASDAQ. The Russell 2000 futures even higher. We closed at 65.84, and we need to get 65.87 for a closing high. It does look like that'll be pretty easy to do on at least at this stage of the day. Deutsche Bank is ringing the bell at the New York Stock Exchange to celebrate Hispanic Heritage Month. The stock is crushing it. The stock is up 360% over the past 5 years. And I'm talking about Deutsche Bank, once the laughing stock of banks and the national bank of the sick man of Europe, has really come back. It's been pretty impressive. Fulton Bank ringing the bell at the NASDAQ market site. That stock is up also over the last 5 years. I always run a comp function before I come out here. Up 150%. So not as much as DBK, but still doing very well down at the NASDAQ. Dani, what are you watching in terms of stocks moving this morning?
I'm looking at the tech stocks because, sure, the NASDAQ looks like it's going to be able to hit another record, but this is the force that might bring it down. Nvidia shares are falling less than we were in the futures session, down by less than 1%. China has ruled that the company violated anti-monopoly laws back in 2020 when it acquired Mellanox Technologies. China also said that it's launching an anti-dumping investigation targeting a type of chip made by U.S. companies. That includes analog devices and Texas Instruments. So those shares down nearly 4%. Matt, what are you looking at?
I'm looking at shares of Tesla. You were watching them at the top. They continue to rise 7% basically after a regulatory filing showed CEO Elon Musk purchased about $1 billion worth of the car maker's shares. This is the cult of Elon, so it makes sense for this stock to rise on news like that. We're back with Marija Veitmane there, State Street Global Head of Markets, Head of Equity Research at State Street Global Markets. Marija, I wonder if you think any other industry group has real potential to rise here in U.S. stocks other than tech. We've talked about your tech earnings forecast. I think 26% is what I saw most recently for 2025. Who's second best?
That's actually a really good question. And we spend a lot of time in our kind of strategy team discussions about that, scratching our heads. So, I mean, tech is by far the best. I think the second best with a kind of long behind. I think the area we're looking at is actually healthcare. So healthcare is the sector that is the most unloved sector. So institutional investors in the State Street custodial database are really, really underweight sector. I mean, I would probably like to give you a sense of it. The size of tech overweight of benchmark position is smaller than the size of healthcare underweight. So just to give you an idea how much people really, really don't like healthcare sector. And we're beginning to see some signs of earnings improving a little bit. There are lots and lots of issues in the sector. I mean, don't get me wrong, but given the positioning, given the kind of huge discount, maybe there is some catch up. So we're looking at that.
I wonder what you think about the banks. I was just pretty shocked to see the massive gain in Deutsche Bank shares over the last 5 years. And obviously, it's not a U.S. stock, but Christian Saving has done very well to turn that bank around. What about U.S. banks? What do you think of J.P. Morgan, of Goldman Sachs, of Morgan Stanley? How do you sit on those?
I mean, banks, you're absolutely right. Banks done really well, particularly in Europe. But U.S. banks, I mean, they're very profitable. I mean, the thing the issue we have with banks, and actually, to be honest, that's a bigger issue in Europe than in U.S., is that a lot of profits that banks are making are in kind of non-core activities. So banks are doing really well in trading, in investment banking, in asset management. That's fantastic. But those are generally kind of non-recurring revenues. So you shouldn't really reprice banks, which really happened already, and investors kind of positioned for that. So to me, that kind of risk reward is potentially on the lower side, given that we're already positioned for kind of good earnings, and can they repeat them? I don't know. I'm not sure as the economy is kind of slowing down.
Well, good earnings we had gotten, and it comes out of a period for all of corporate America, Marija, that there was a real question as to whether we would get that. Trump this morning putting on Truth Social suggesting that he's going to be pushing the SEC to get rid of quarterly reports, instead have it just every 6 months, so twice a year. As an investor, Marija, that looks through earnings reports, do you think that it would make sense for the U.S. to follow in the footsteps of, I guess, Europe and the U.K. that does not mandate quarterly reporting?
I mean, we obviously need to look into the details, how that will be implemented. But like in general, more transparency is better, more data is better, more chance of corporate managements to communicate with investors, to update them on their kind of plans and products is good thing to have. So I don't know whether you kind of don't report quarterly, but you still like in UK, companies often issue like trading statements and update investors on how they're doing. So we're getting that information, which would be critically important. But I mean, there is a good reason why US stocks in general trade at a premium to European stocks, why cost of capital is lower in US than in Europe. So all those kind of better regulation, transparency is helpful. So I mean, as an investor, I think it's very important to keep this kind of close look at how companies are doing.
We do see, so many stories. I guess maybe the evidence is anecdotal, but I'm sure that papers have been written on it about privatizing a company like Michael Dell once did, and that way you don't have the scrutiny of Wall Street on you, and you can make changes that are geared towards the longer term. This is kind of the Chinese model, and President Trump often looks to China as an example of how he wants America to be. You don't think that would be helpful across the board for investors? You think that we would do better having, constant commentary and scrutiny, constant transparency from quarterly reports?
I mean, so there is obviously a trade-off bit. I mean, there is on one hand, on the other hand, but I think extra transparency, extra kind of communication with investors, that's something that keeps like cost of capital, cost of equity lower, ability to kind of talk to bankers, talk to market, update on the story. I think that's important. That also ensures kind of more gradual price moves as opposed to kind of all of a sudden we learn something about companies that we had no idea, no transparency. I mean, so some like corporate governance issues. So I think as an investor, as an analyst, it's better to have more information than less in general.
Marija, thank you so much. Thank you for bringing us all of your information. Marija Veitmane of State Street. Matt, I think comparing things to China is always an interesting choice. But Marija pointed out even in countries where you don't have the urge or the necessity to report quarterly, they still give trading updates. Like, that is still a cost. If you're trying to save money, I don't know if this necessarily does it.
All right, it'll be interesting. That'll be an interesting question to put to CEOs, right?
For sure.
That we talk to, and we talk to them every day here at 10:30. We'll ask the CEO of Exact Sciences today how he would embrace that. I'm just marveling at Deutsche Bank still, and how well, because I lived in Germany for so long and reported on this company. I talked to James von Moltke, the CFO, every quarter. At one point in 2020, their price to book was below 0.2. So they were trading for less than 2/10 of their book value. Even in 2022, it was only a quarter. So to see them get back to this level, price to book ratio, they're worth almost as much as the book value of their assets now, is pretty impressive.
That is very impressive. But let's talk about more American companies.
Yeah, yeah. We'll focus on what's going on in the stock market right now. What do you got, Dani?
All right, well, look, it's the push and pull between the two Mag 7 giants. It is Tesla versus Nvidia, which is going to win out. The thing moving equities higher this morning is Tesla, up 5.5%, up more than that. Given its weight, it is the biggest push upward for this index. But it's interesting to see some of the losses from Nvidia starting to kind of not look as severe. It's actually here. It's on the 8th mover list down over here, or bopping around there. Nvidia down about 1.5%. Texas Instruments, that's also China related, with China investigating anti-dumping. So again, it's tech and Mag 7 both leading us and hurting us this morning. By the way, Oracle is still in the column of things gaining after that monster earnings report yesterday. Now, when it comes to the individual sectors, we are looking kind of an even split. It's consumer discretionary that's leading the way highest this morning, up 1.7%. Interestingly, comms is up there too, 1.3%. Financials does well. On the downside, you do have energy and materials dragging us down. Again, tech is basically unchanged because you have those two forces, the Tesla versus the Nvidia versus Texas Instruments, leaves us pretty flat. But we are up 1/3 of 1%, Matt. So if we can do that, another all-time high.
Yeah, it seems highly likely. Coming up, China targeting the U.S. chip sector amid trade talks. We'll discuss that next and give you the implications as President Trump gears up to meet with President Xi on Friday. This is Bloomberg Open Interest.
All right, a quick check on stocks this morning. We are higher across the board, looking at closing at another all-time high for both the S&P and NASDAQ. This would be the 9th consecutive day of a rally for the NASDAQ if we can get it. Let's get you some top calls this morning, though, some of the analyst action that we are focusing on. First up, Union Pacific getting upgraded to a buy at Citi. Those shares still flat, though. The firm says that the recent drop in shares is creating a buying opportunity. Not many people taking up that opportunity this morning. Next up, Under Armour, that gets a cut at Rothschild & Co. The firm admits that it was too optimistic on the company's turnaround and says that tariffs and slowing demand will push back recovery. Finally, Beyond Meat, that gets cut to a sell at Argus. The analysts there citing ongoing softness in the plant-based meat category, especially in the U.S. Matt, those shares falling 1 1/3%.
Have you had a Beyond Meat product?
I have. I've had it at a restaurant that served Beyond Meat, and it was fine. It was okay.
It was good?
I mean, it was fine. I wouldn't seek it out instead of meat, but it was okay. Especially smothered in cheese, which I think defeats the purpose. But yeah.
I ordered it once at the Ned at the brasserie there, and I will never do that again.
Really? It was that bad?
Yeah, horrible. All right, let's turn to technology in the form of chips. Nvidia shares falling after China ruled that the company violated anti-monopoly laws back in 2020 when it acquired Mellanox Technologies. Bloomberg Intelligence senior analyst Mandeep Singh joins us now. And Mandeep, what does this mean? You know, what will happen as a result of this, especially if they find they don't like what happened in that takeover?
I mean, right now it's part of the ongoing negotiation that's going on between the China and the U.S., and the timing of it is clearly influenced by that. But look, in past cases, wherever there's been an investigation, well, if they find something was off, there could be a fine, especially since the acquisition took place in 2020. So to my mind, every jurisdiction has their own way of going about, looking at some of these things where they feel something wrong took place. And if they find, a company was at fault, they will put a fine and you move on.
They have already, at least twice this year, the Chinese Communist Party, through various regulatory arms, has told companies locally, do not buy these Nvidia chips. Are companies in China still buying those Nvidia chips?
They are, and in fact, Nvidia actually called out how big the Chinese semiconductor GPU market is. They said it's almost $50 billion a year, and they expect it to grow at a CAGR of 50%. So that just goes to show how big the market is, and I think from a Chinese standpoint, now that they know everyone is kind of looking to tap that opportunity, that's their leverage in these type of negotiations, given TikTok is also on the table, given there are so many other things at play, then this becomes one of the issues that they can leverage when it comes to negotiating with the U.S.
I was going to say, how much do you really want to be pessimistic on Nvidia around this? If it is just, okay, maybe this is just a tactic for the talks and maybe something that doesn't stick.
Well, so Nvidia said in 3Q they could ship up to $2 to $5 billion of H20s to China. Well, if something like this happens and obviously things don't go very well, then that's where the upside to the quarter is limited, because there's no doubt that, if Nvidia beats and raises, China would be a big part of that beat and raise.
And it's not just Nvidia, right? It's anti-dumping for other chip makers, too, that they're focusing in on.
Yes, I think AMD gets impacted as well, but the scale at which Nvidia operates is far bigger than any of the other chip makers. In fact, Synopsys was another company that missed, and they had China as one of the reasons where they couldn't sign multi-year agreements. So you could see, any chip company or related company that's exposed to China is getting impacted right now because there's no long-term commitment from the Chinese customers who are using these products.
Yeah, Texas Instruments also down this morning, a decent chunk too off the back of that. Mandeep, thank you so much. Those shares down 3%. Mandeep Singh of Bloomberg Intelligence. Coming up on the show, President Trump says companies should not be forced to report earnings every quarter and instead should take a page from China with a 50 to 100-year outlook. We have those details next. You're watching Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. Right now, the S&P 500 gaining 0.4%, 6610. That puts us at an all-time high if we close at this level. Also an intraday high. The NASDAQ also going up by 0.5%. So now the NASDAQ 100 moving even more strongly than the S&P 500. And it had been the problem that Nvidia was down. We still see the shares off about 1% here, and they are obviously more heavily weighted on the NASDAQ 100. You've also got TI shares down, other semiconductor shares down on concern about the investigation in China. Tesla up 5% right now after Elon Musk bought $1 billion worth of those shares. That's after he got a $1 trillion pay package if they meet certain criteria. So some interesting stories, but I think none other than President Trump's tweet this morning, which would be a tectonic shift for corporate reporting if it happened. Dani, we have a fantastic guest to talk to.
Yeah, we really do. So first, the details of what President Trump said, that basically companies shouldn't be forced to report quarterly earnings. He posted on Truth Social saying that he preferred reporting every 6 months to save businesses time and money. Bloomberg Lots Co-Host Joe Weisenthal, that fantastic guest you were saying, Matt, joins us now. Joe, thanks for coming around to the desk.
Thanks for having me.
I mean, I think generally there's this idea that more transparency is a good thing. So who wants this?
Well, here's something I've been thinking about a lot. It feels like inevitably we are entering a world in which there's probably going to be less transparency for the average investor than there has been. And I hadn't really expected this, but you see it in the rise of entities trying to sell VC-like equity to the public, private equity to the public, this blending of the public and private worlds, retail participation in, the SpaceXs of the world and so forth. And obviously that entails a certain less transparency or knowledge of what's happening on a day-to-day or quarter-to-quarter basis for those investors. So it feels like a move, if this happens, of going from 3 months to 6 months, would be very consistent with the broader trends where all of these expectations for how much we know about companies at a given time are sort of blurring these lines between public and private.
All right. I want to just quickly look at what's going on with Google shares. We have some breaking news here that Alphabet, the parent company, has surpassed the $3 trillion mark in market value, which doesn't matter, obviously. But those big round numbers are key. I remember when Ed Ludlow said that Apple had surpassed $3 trillion. So there's a milestone for you. In terms of quarterly reporting, there have been studies I've read, I'm sure, in The Economist and elsewhere, that you can do better if you don't have to submit to that kind of scrutiny so often, right? I mean, there is a point to a longer-term outlook than just every quarter looking at the numbers, right?
Yeah, no, that's totally true. I mean, I think a lot of people intuitively feel that, everyone has seen those famous charts of like GE back in the day when every quarter was spot on or whatever with the estimates. And I think there are a lot of people who intuitively feel that companies shouldn't be so, quarterly focused. Whether the formal changes in reporting requirements would actually cause a more long-term outlook, like long-term thinking about capital allocation, I don't know. But I think like the intuition that, one quarter can be noise is not that bad. Something else to think about is that professional investors, especially like at the elite, like hedge fund level, they rely on a lot more than what the company says, right? They have alternative forms of data, they have expert networks that they can tap, et cetera. So probably for the marginal price setter that has resources, they'll probably still have a pretty good read on a sort of month-to-month, week-to-week basis of how their investments are doing.
Just listening to you talk, though, it just sounds like the net outcome is bad for retail investors. That, like, maybe you don't have access to sell-side notes, you get to talk to CEOs and get an in-look to the company. That, like, the everyday investor is the one that maybe loses out in this.
Something that I think perhaps goes underappreciated when it comes to U.S. Capital markets is just how much better than they are than almost every other country in the world in terms of how much data you get and how much transparency there is and how many rules. People look at SEC actions and they find some like small fry insider trading thing that they go after. And they're like, what was the point of this? Or you only caught them after. Or they hear about scandals after they've blown up. It's like, thanks a lot, SEC. But I do think there is sort of like an unseen benefit from the fact that by and large, companies that report on U.S. markets, that are listed on U.S. markets, are held to a pretty high level of transparency, both in terms of data, in terms of the arrangements of their boards, and so forth. And it does put U.S. capital markets sort of a cut above even a lot of other rich countries, et cetera. So the degree to which we may be giving some of that up, I think is something to think about when contrasting with the benefits, which are probably real to some extent, of not having to prepare a quarterly so frequently.
Joe, we only have 30 seconds until the break, but tell us about your odd lots on corrugated boxes.
Yeah, we talked to Ryan Fox, who's the Bloomberg Intelligence corrugated box analyst. And corrugated box, actually cardboard box volumes in general have been pretty mediocre this year. As we talked about the read-through from the cardboard box market to the broader U.S. economy, clearly signs of a good slowdown, which we know from other, quarterly earnings reports from publicly traded companies. But it's one of the more fun episodes we've done in a while in terms of learning about a field I had known nothing about. So much innovation happening in the cardboard box space. You got to check it out.
We'll see if it matches up to the chicken episode, which is still my favorite. Joe Weisenthal of the podcast Odd Lots with Tracy Alloway. This is Bloomberg. We are 30 minutes into the trading day on this Monday morning here in New York. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. With equities headed for another record high, both the S&P and the NASDAQ just grinding as we await that Fed decision on Wednesday.
Yeah, we are awaiting President Trump as well, his meeting with Xi on Friday. Meanwhile, he wants to scrap quarterly earnings reports, a move that could create a tectonic shift in U.S. equity markets.
The president also saying that he'll speak with Xi Jinping on Friday as China raises tensions by investigating Nvidia.
And go big or go home, President Trump predicts a hefty cut from the Fed as officials juggle a high-stakes moment for the U.S. economy. And he has been pressing this for quite a while. This isn't the first time he's tweeted about wanting a big cut from Jay Powell, whom he called incompetent today. We begin, though, with the Nvidia story. Those shares falling after China ruled that the company violated anti-monopoly laws back in 2020 when it acquired Mellanox Technologies. Bloomberg Tech co-host Ed Ludlow joins us now for more. And Ed, we were talking with Mandeep about this earlier. China has been urging domestic companies not to buy Nvidia chips. Now it's investigating monopoly accusations. They really want to shut Nvidia. Do they really want to shut Nvidia out of their market?
No, it's a timing story and a negotiating tactics story. You know, the Chinese regulators dropped this piece of news, I think, within minutes of Secretary Bessent giving us the update on the status of Madrid talks between the United States and China. You know, it relates to the 2020 Mellanox acquisition. It gave Nvidia a place in networking, which is something now, present day, it talks up a lot. The decline is beyond 1%. But as you guys know, in the analog semi space, you also have China taking anti-dumping action against names that like Texas Instruments analog devices that might be impacted. And with Nvidia, the H20 issue is still at play. So I think the way the market reads this, I'm pretty confident the market reads it, is that, you know, Nvidia is putting, China is putting Nvidia in the center of the negotiating table. We just don't know what it is that China wants vis-a-vis Nvidia from the US at this point.
And elsewhere in tech, we have a new member of the $3 trillion market cap club, and that is Alphabet. What's thrusting it higher? What does this landmark mean?
Yeah, a story for many weeks, because there has been so much volatility in the news cycle, has been that when we had that earnings period, Google Cloud made a lot of gains, right? There is this specific catalyst in the courts where Alphabet or Google was not required to divest Chrome, but the name had a lot of momentum because it demonstrated in the most recent earnings that it was taking market share in cloud. And not only that, but there was some evidence, much like we've seen like names like Meta, where the investment in AI is starting to boost a little bit the bread and butter business. This is a milestone that, I don't know, as you guys know, sometimes I go on vacation. Weren't you guys looking at this milestone a few weeks back when I was off anyway? It's happened. Where they stay in the pecking order, who knows? But it's fun.
It is fun. Thank you for that, Bloomberg Tech's Ed Ludlow. Yeah, Matt, the $3 trillion plus club is Nvidia, Microsoft, Apple, and now Google as well. Yeah, the first company ever to cross that threshold was Apple, and I remember listening to Ed say that on Bloomberg Tech. So now they've got a lot more company. Let's continue our conversation now on trade and tech with Rebecca Patterson, Counsel on Foreign Relations, Senior Fellow and former Bridgewater Chief Investment Strategist. I think first on trade, you know, the meeting is the most interesting with Xi and Trump, what to expect from that this Friday. But in the meantime, President Trump has tweeted or truthed that he would like to get rid of quarterly reporting. And this is something that he talked about in 2018. The SEC looked at it then and didn't really do anything about it. Would that ever be possible? I mean, wouldn't investors clamor for their quarterly numbers anyway, even if it weren't a requirement?
I mean, I think there's a theory here and then a reality. Like the theory, if you report less, you can have a longer term mindset. You're not always reacting and just trying to game the system to beat that consensus earnings expectation. But the reality is that people do need transparency. They need information. And within companies, you're doing this exercise anyway. You need to know where your company stands every day, forget every quarter. So yes, you'd save an incremental cost, a little bit of time, but I think you'd probably pay for that with higher risk premium around stocks because there's a greater chance that you could get a surprise. And it's not going to change how a company invests over 5 or 10 years. It won't matter at all.
It's so interesting because of the benefits and the depth of liquidity in the U.S. markets to compare with, say, China, which President Trump did, or even the UK and EU, which don't require that, and that themselves are trying to think of reforms in order to increase their capital market liquidity. Rebecca, just given that and what you're saying, is this essentially a solution in search of a problem?
It certainly grabs headlines, and President Trump and the administration like to show they're active. They like to show they're business friendly. I think this does come across as business friendly. Again, it saves time and money for publicly listed companies. But President Trump and the administration also say they're standing for the little guy, Main Street. And in my mind, this is not helpful for Main Street. The retail investor today, playing a bigger and bigger role in the markets, needs that data. They don't have the insider dinners and the alternative data sources that perhaps some of the institutional investors do.
They don't all get invitations to the executive branch birthday party for Chamath.
Yes.
Let me ask about trade then. You know, things seem to have calmed down so much since Liberation Day. Obviously, the market tanked, it's recovered, and we're catching up to almost the kind of gains that are seen in European indexes now. Is that volatility behind us? I mean, has the market learned to tune out the louder headlines from the White House and just focus on earnings going forward?
You know, I think we're in a world now where AI and tech, I guess we should just say tech, is driving both the economy and the markets. We know that the top 30 or so biggest AI-related companies are about 43% of total market cap for the S&P. They're driving almost all of the earnings. And the CapEx and research and development spend is really supporting the broader economy. The first couple quarters of this year, it was a bigger support than the consumer, which is a big deal. So we're all living on this AI roller coaster. The challenge is that if you strip the AI away, things don't look as good, right? The housing market is somewhat paralyzed. The labor market is softening. And to your point on trade and tariffs, we are seeing it creep through more slowly and less aggressively than initially expected, of course. But if you just look at the last month's CPI report, core goods is up about 1.8%, 1.5%, I think, on the last year. And in the last 3 months, it's been running at 2.8% annualized. That's tariffs. And I think from the Beige Book and other corporate surveys we see, that's going to get worse, not better. So the underlying consumer is struggling a little bit. They're still spending, but they're starting to struggle. And AI is masking all of this. So we just feel like we're on this awesome joyride, but not everyone is joyful.
Well, when the AI masking it is just a handful of hyperscalers, Rebecca, what happens if we get a scenario where once again shareholders don't reward AI spending, where Meta decides to stop paying sports-like salaries to new researchers, where they decide to stop plowing hundreds of billions of dollars into the economy? Do we get a recession just because one company decides to stop spending?
The risk of that is growing as the power and market cap concentration gets bigger and bigger. I'd say the other risk, which ties into how you open this segment with the talks Friday between Trump and Xi, is that China has a lot of leverage here. If they shut down our ability to get magnets and rare earth minerals, that affects our chip supply, that affects AI. So they do hold a lot of leverage. And then again, just as they tried to do in Nvidia today, export controls, boycotting of different technology from the U.S., that can have an effect. And of course, DeepSeek. So just a reminder, they're not just sitting still. They're pushing ahead on their tech too. So I do think tech is a huge support right now, but it's also creating more and more risk that we have to be aware of, especially at these valuations.
Well, and this administration has shown, it seems, a willingness to trade national security for access to short videos that everyone's become addicted to, right? I mean, in the first administration, President Trump wanted to ban TikTok using IEEPA because it allows the Chinese to spy on us. And now it looks like we're willing to do anything to keep TikTok so that they can keep spying on us.
Yeah, and TikTok, look, I agree. I mean, the fact that we're now allowing U.S. companies to sell chips to China as long as the government gets a 15% revenue stake from any profits received, like, it is a question on, do we want to have champions that dominate the global landscape in chips and AI, or are we more focused on national security? Where do we stand on this? And from day to day, it's not clear to me where our administration stands. TikTok, if we have a deal Friday, that's good news. We can say we're winning on China, even though we're still a long way from a trade deal with China. I mean, China's boycotting U.S. soybeans. Farmers that supported President Trump are getting hit. Congress has to bail them out again. So I think a TikTok deal Friday almost to me feels like, see, we can win with China, because the reality is China has a lot of leverage, probably more than most people in the U.S. would like to admit.
But also, who cares about TikTok? Why do we care?
The kids I don't care, but I would guess lots of teenagers do.
I just don't understand it.
There are literally entire businesses that are built off TikTok. This is the new economy.
There are U.S. companies that offer the same kind of format. We don't necessarily need to allow our youth to be addicted to this Chinese company that's feeding us videos.
I'm with you, but I think a lot of people watching this would want to like throw things at us for just saying that.
Well, probably because they take away TikTok. What happens? We use like Red Note or the other popular Chinese app. It doesn't necessarily go to Meta.
Just more shorter YouTubes. YouTube can expand into some new thing.
Instagram has it. I mean, everyone has.
By the way, I don't think those
form.
things are healthy either.
Vine.
They're just not owned by the Chinese.
Yes.
Yeah, that doesn't exist anymore, but fair point. Rebecca, we have a lot more to talk about. Rebecca Patterson, of course, of the Council on Foreign Relations, is going to be sticking around with us. Let's get a look at some of the individual stocks that are moving this hour. And Matt, it's the market cap threshold, the achievement of Alphabet, now worth $3 trillion for the first time. What's driving it today? Citi raising its price target to $280. Apparently, that alone is enough to get a rally of nearly 5% this morning.
So you've got Alphabet, you've got Apple, you've got Microsoft, and obviously Nvidia. So 4 members of the over $3 trillion club.
Yeah,
so
exactly.
far.
And Amazon's like just below that at $2.4 trillion too.
You can, and what screen are you looking on? The S&P 500, you're looking at MEMB.
Exactly, that is the screen.
MEMB, go. Shares of Tesla, you saw there higher after regulatory filing showed the CEO, Elon Musk, bought $1 billion worth of the car maker's shares. And Alaska Air says its quarterly profit was hit by a technology outage and rising fuel prices, and as a result, those shares are down. By the way, they changed their logo and no one said anything about it.
Apparently, Shelley Banjo says they might have not changed their logo. There's a little bit of confusion about that.
Do they still have Jerry Garcia on the tail fin?
It's not Jerry Garcia. I can tell you that much.
Coming up, we're going to get more with Rebecca Patterson of the Council on Foreign Relations. We'll get you a look at that Alaska Air tail fin as well, and talk about what to expect from the Federal Reserve this Wednesday. It's coming up. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. Top Wall Street strategists are warning that the record-setting equity rally could run out of steam after an expected Federal Reserve interest rate cut this week. Strategists from Morgan Stanley, JP Morgan, and Oppenheimer say a more cautious tone may replace the bullish mood as investors focus instead on a potential economic slowdown. And BlackRock is converting 2 mutual funds into ETFs to better fit the strategies into the firm's booming model portfolio ecosystem. The funds, managed by Rick Reeder, will become the iShares Dynamic Equity Active ETF and the iShares Disciplined Volatility Equity Active ETF. That's a mouthful. President Trump says companies should not be forced to deliver earnings reports on a quarterly basis. In a post on Truth Social, he wrote that he preferred a 6-month schedule because it would save businesses time and money. The SEC didn't immediately return a request for comment on this proposal, which Trump also floated during his first White House term, and we've been talking about Dani a lot today.
Yeah, we have. And of course, in 2018, something also endorsed by Jamie Dimon and Warren Buffett, as you pointed out. Now, elsewhere this week, because it is an insane week, investors are also waiting the Fed decision on Wednesday. President Trump pushing the central bank to go big.
The Fed chairman's incompetent. I think you have a big cut because I don't think he can help with cutting. It's perfect for cutting.
So we are counting down to that decision on Wednesday. The central bank is widely expected to cut rates by 25 basis points. Back with us is Rebecca Patterson, Counsel on Foreign Relations Senior Fellow and former Bridgewater Chief Investment Strategist. Rebecca, I mean, it's pretty much assured we'll at least get 25. Maybe the more interesting thing is what happens from here. How much of what happens from here, though, is dependent on what the board and Fed leadership look like in 2026?
It absolutely matters. Yeah, I mean, I think our best case scenario is that inflation starts to come down again and growth holds up okay, and the Fed can do one or two insurance cuts, similar to what Alan Greenspan did in 95, 96, and we extend the expansion. And that would be disappointing on the rate side, but great news on the economy side. Stocks would like it. I think our worst case scenario is that we get a politicization of the Fed, which, to be fair, probably couldn't happen thoroughly till next February or so. So they'd have to replace enough Fed presidents, and that means you need 4 governors who are going to be on board with firing Fed presidents. So it's a question mark. I'm not sure this is going to happen, but it's not a zero probability. If we get there and we get lots of Fed cuts, we get the 6 Fed cuts that are now priced in by the end of next year, you're going to be juicing this economy and having inflation not running at 2.9%, that's the headline CPI, but maybe 3.5%, 3.9%. So you might have a very strong equity market for a while. You might have a stronger economy, but an economy running that hot is going to really hurt the consumer because their wages are not going to be going up as fast as prices are.
Yeah.
So I worry a lot about that scenario, even though it's probably still a small probability.
I mean, I'm focused on the inflation because I'm raising a young family. I live in a high-tax suburb of New York City, and I'm just watching at the grocery store. And, you know, when I look at car prices, so everything from small to big, just rising what feels like exponentially. Obviously, if I had lost my job, I'd be much more focused on the labor side of the picture. But does inflation, you think, ever come back down towards 2%? Or are we in a world where 3% plus is where inflation is?
I mean, if the labor market cracks, and we are hearing in surveys like the Beige Book and from CEO confidence surveys that we are likely to get more layoffs next year. So if we see that unemployment rate rising more, job cuts getting bigger, that could bring down wages. You could see inflation coming down. But remember, inflation coming down happens in recessions. So that's not a great, like, it helps us on inflation, but that means a lot of our friends and family members and maybe us are out of jobs. So I don't think we want to see that solution to inflation. The Goldilocks disinflationary world, hard to see it without tariffs going away, hard to see it with the economy running relatively resiliently. The labor market's soft, the housing market's paralyzed, but the consumer's still spending. And so it's not clear to me which one cracks. I guess I'm nervous that even if the Fed cuts, is it going to be effective to solve these problems? So if you see 50 basis points of cuts this year, are companies going to say, oh, great, now we're not going to lay off workers? I don't think so. If we see 50 basis points of cuts, given what's already priced into the 10-year, do you see mortgage rates coming down another 100 basis points and freeing up the housing market? Maybe, but that seems like a lot to ask. So I worry that we're not going to get many cuts as expected, and that with the cuts we get, they don't necessarily materially solve the challenges under the AI hood.
There is this argument, and Mike Wilson, Morgan Stanley, is among those making it, that you need a Fed that cuts at pace, that you get some fiscal stimulus, and that we have to run things hot because of the deficit, that running things hot will be the thing that solves the deficit problem, and that for corporate America, they can deal with it. They had high inflation during COVID, and stocks still went up. What do you make of that argument?
I mean, yeah, you can inflate the debt away, and it will hurt every person in the United States who's a net saver, i.e. retirees. So I'm not sure that trade-off is worth it. I think what we want to do is focus on investments from the public and private sector that drive growth and productivity. So more on the supply side. So if we invest in research and development, if we invest in innovation, if we invest in infrastructure, things that we know will have a positive return on investment for the economy,
which they've done, to be fair, in one big beautiful bill, right? In
Well,
terms
they did in some parts of it, but
Yeah.
at the same time, we're cutting research and development, right? So R&D, government funding R&D is down a lot. Innovation is down a lot. Getting those highly skilled immigrants in to work at various companies is going down. So some things yes, some things no. There's a bit of both going on right now. And AI is at some point going to create more productivity growth, which will help the economy too without inflation, but we don't know how much or when.
Rebecca, we never have enough time with you.
Oh, thank you.
Really great to have you here
Love
with
to
us
be
on
on.
set. Rebecca Patterson there, the Council on Foreign Relations. This is Bloomberg. Let's get a check on the stock market right now and see what's going on with the move screen. It's the most dynamic way to look at the S&P 500. You can see that we have gains that have been retained, at least for the first hour of trade. And you're looking at the big gainers there. Seagate Technologies, Albemarle Corp. These are obviously the percentage gainers and not the point additions. But Tesla is right up there in terms of one of the biggest percentage gainers after Elon Musk buys $1 billion worth of stock. And Alphabet as well, as it jumps through the $3 trillion mark. We'll be back with more from the CEO suite when we come back. Exact Sciences is introducing a new blood test designed to detect cancers. We'll talk to the CEO. Exact Sciences is unveiling a long-awaited blood test designed to detect the early stages of cancer. The Cancer Guard test is said to help spot the signs of more than 50 different types of malignancies, excluding breast and prostate cancers. Joining us now to talk about the technology is Kevin Conroy, the CEO and chairman of Exact Sciences. Kevin, great to get you on this morning. Tell us, first off, for the layman here, which most of us obviously are, how this test works and why you exclude breast cancer and prostate cancer.
Sure, and let's talk about the problem. The problem is that cancer is the #1 cause of death among people who are under 85. That's 600,000 people a year, and 2 million people are diagnosed. So it's the #1 health problem if you look at it through that lens. And today we're screening for only 4 types of cancer. And there are 50 types of cancers and subtypes that we can screen for now, 1 blood draw, all of those different types. And the goal should be finding cancer as early as possible when it's treatable. There's early stage cancer, and early stage cancer generally doesn't have symptoms, but it's also small and localized and treatable. Late stage cancer, however, is spread throughout the body and sometimes doesn't have symptoms. So the whole goal with Cancer Guard is to shift detection to the earliest stages when it is most treatable. And it's powerful science. We're kind of at the dawn of a new era. The reason that we don't search for prostate cancer and breast cancer those are uniquely 2 cancers that don't shed a lot of DNA into the blood, so they're hard to detect. And an important thing to understand here is that this test is not intended to replace the current screening that people undergo. It's to screen for the 70% of cancers for which there is no screening method.
Kevin, the ability of this test also to detect cancer on your trials is about 64%. Again, a layperson might look at that and say, that's not exactly a high figure. It is better than 50% than even odds, but 64%. Is that high enough to use this as a screening for population screening, that sort of thing?
It is, and here's why. Because today what we do is we find cancer symptomatically, which means it's not 64%. It is 0% until that cancer grows large enough to actually start to present symptoms. And cancer, and I never knew this, but cancer actually takes up 1 to 3 years to advance from early stage to late stage. So you have a lot of time to find that. And if you can go out into a population of, let's say, 100 million people over the age of 50 and find 2/3 of cancers tomorrow? Would we? Of course we would, because then you're finding it when it's eminently treatable. There just is no therapy as powerful as earlier detection. But now when you couple earlier detection with the advanced therapies that are being developed, you have a total new paradigm to actually start to change the outcomes. Earlier detection, better outcomes.
You have a competitor, Grail. It has a cancer test, Galeri or Galeri, depending, I guess, on where you're from. And it's a lower price at a lower price point. Why is your test better? Why are you charging more for it?
It's the opposite. We picked a lower price point than others who are here. And the reason that we picked a lower price point at $689 is because we want to democratize testing. We want as many people to have access as possible. Over time, we believe Medicare will be able to cover the test. There's a bipartisan bill with over 350 co-sponsors today to allow Medicare to evaluate and potentially cover this class of testing. We think that the more companies that are doing fundamental research and involved in this space, the better it is for patients. We believe CancerGuard is the test that will ultimately be the most successful in getting the most people screened.
Kevin, you've been at Exact Sciences for some time now, since 2014 and 2009, perhaps before that, acting in different capacities. You've been with this company as it's had to report every single quarter, as is mandated by the SEC. We would really love to get your thoughts this morning. President Trump putting out on Truth Social saying that he would like to see the SEC take away that requirement and just have a company report every 6 months. What do you think about quarterly reporting? Is it good for corporate America? Would you like to see that move to a system where the mandate is just twice a year and optional if you want to report quarterly?
I think I just had my 70th earnings call. And
congratulations.
There are that I would prefer to do than do an earnings call. But here's what I thought about this on the way into work this morning as I heard this on the radio. And look, I think that transparency is so important in public companies and integrity. And the process of reporting financials every 3 months allows a company to share the information, allows investors to decide where that company is in their process. I think that frequently investors are too short-term focused and not enough long-term focused. Maybe this would extend that out. But on the flip side, there would be less transparency and investors would have less information. I tend to believe more information is probably better for investors.
Well, Kevin, thank you for also sharing more information with us. We know even if quarterly reporting goes away, we would still love to have you on this show giving us those updates. Kevin Conroy of Exact Sciences. All right, Matt, let's get a quick check on markets this morning because we are just over an hour into your trading day. We're up nearly 0.5%, even more for the NASDAQ. It would be the 9th straight day of gains. We would be trading and closing, if we close at these levels, at another record high. It's this feeling of we just keep grinding higher and higher, regardless of what the headlines are, regardless of what the Fed does maybe on Wednesday.
Yeah, or maybe because we expect the Fed to do this on Wednesday. We're now looking at firmly at double-digit gains for the S&P 500 at about 13% year to date, and that eclipses a lot of the European gains. Now, for a long time this year, for the first year in many, Europe was doing better than the U.S., but the Euro Stoxx 50 is only up 11%. And I'm looking at it in local currency.
Well, the other thing I was looking at, Chinese equities are up 34% this year versus 15% for the NASDAQ. So China sneakily has also been outperforming everything in the U.S. too.
Yeah, absolutely. I mean, there's some pretty surprising gains on some individual indexes. In Europe, the DAX is up 30% year to date. The IBEX is up 32. The FTSE MIB is up 25. So we still have to catch up to a lot of those more regional indexes. But it just looks like everywhere around the world, risk assets are rallying.
Well, maybe we'll look more like Europe and not have quarterly reports. So there you go. We'll catch up.
It seems unlikely. But we'll continue to report on that. Let's get a look at some of the single stocks moving this hour. Nvidia shares under pressure. right now down 1 1/3% after China said the chip maker violated anti-monopoly laws with a high-profile 2020 deal that, as Ed Ludlow tells us, is really just ratcheting up pressure on the Trump administration during negotiations right now in Madrid. And at the end of the week, the two presidents will meet.
And also, any AI spending is good spending. CoreWeave shares, those are up nearly 6.5%. It struck a $6.3 billion cloud computing deal with Nvidia. So again, those shares move higher.
Robinhood is launching a closed-end fund to give U.S. retail investors exposure to private companies. And this is a trend that we've been talking about for years now that just continues to grow in strength, right? The idea of private markets being accessed by retail investors, just gaining on every front.
Yeah, and you have the likes of Carlyle, for example, taking a sponsorship with the Red Bull F1 team, trying to get their name out there, say, hey, retail investors, pay attention to us.
She's a fan of F1
both,
racing.
Well, both of private equity and F1 racing, so yes.
Coming up, complex bets that fell out of favor after the collapse of Lehman Brothers are popular again, and they've been tagged Boomer Candy. Today's big take is next. This is Bloomberg Open Interest. Today's big take looks at the boom in structured products. The U.S. market for these hybrid securities grew to a record $200 billion last year, and it's on course to top that this year. Gary Garland, a 58-year-old wealth advisor, has bought for himself $450,000 worth of these structured products, investing his own money alongside that of his clients. And this is what kind of really got me yesterday when I was reading this story. I read it last night and I thought, what a cool anecdote. This guy's willing to put his money where his mouth is. And these are products that got very popular until the financial crisis, the collapse of Lehman Brothers, which backed a lot of them. And so investors lost billions when they went out of business. Let's bring in the author, Bloomberg's Yi-Chin Shen joins us. She covers equities and arbitrage trades for the U.S. This is such a great story. I sent it around to all of my colleagues after I read it, and I recommend everybody go on the Bloomberg terminal or on Bloomberg.com and check it out. Basically, these are products which wrap bonds together with derivatives and allow you to take less risk but still get a decent return, even if stocks go up or stocks go down. Bidirectional, I guess, profit trades. Tell us about structured products.
Yeah, sure. Thanks for having me. So first of all, structured notes is this hybrid instrument. So think about it as a bond, and on top of that, it has a option twist. So the bond component is where it promises you some sort of a fixed income protection. So you will get some level of downside protection, coupon, income component. And the derivative part is what really makes it spicy, because now you have your income ultimately payout linked to some other asset. So it could be a stock, an index, or basket of that. So ultimately what you get will depend on how your underlying performs.
There's always creativity in finance, and with that, the argument always comes, what these creative types are doing are just riding a bull market. That what you're doing is just capitalizing off of an equity market, and a bond market may be questionable, but an equity market that just continues to go up, and when it falls, these things get hurt too. Does that argument stand for these types of structured products that Gary loves so much?
Yeah, I would say yes and no. So to the popularity or why the boom right now is there's a big appeal in this product is that it gives you some sort of equity upside, right? So for people who fear of missing out, okay, owning structured products, you get that upside and give you some downside protection. But remember, these products are not bonds. So there's a range. As long as the underlying perform within the range, you're fine. But if the market really started to fall and flops, that's where you could potentially lose your principal and get nothing back or lose a lot of that.
So I was wondering about that. Like, what's the catch here? Because initially in the story, the way you describe these products, it sounds like a win-win. And then I see that they're backed by big names, right? One of these products that Garland bought is backed by Barclays. But of course, Lehman Brothers would have been a big secure feeling name before 2008 as well. So how big of a risk is that? Is it that the underwriter somehow goes out of business?
Yeah, I would say that's a really good question. So the biggest risk for all these products is credit risk. And that is a hard lesson we learned from Lehman, right? Because ultimately, these are the issuance. So your products stay as much as they can pay you back the principal or the promise coupon. But what happened during Lehman is that it wiped out billions of dollars of structured notes. And I would say another risk, it's less so about a systematic risk, but I will call it a problem, is that these products are still overly complicated for an average retail investors. So many critiques will say, like, do mom and pop investors really know what kind of things they are buying into? The different scenario, the mechanism of payouts. They thought they are being offered with a bond with much higher coupon, but there's a catch or there's condition of that, right? There's a chance you could occasionally lose money on that.
Is the winner of all this also just the banks, the issuers who are selling these that are becoming increasingly popular?
Yeah, that's exactly that. That's actually one reason that also behind the boom this time around is that it's a very lucrative business for the banks because banks prepackage and issue these products to retail investors. So they typically can charge 1.5 to 3% of fee, as much higher than like an option-driven ETFs. So they love it, right? And they keep pumping it up. And also from a risk perspective, after Lehman, they have started to hedge most of their risk on their book after issuing these products, or even recycle some of that to other banks or hedge funds. So ultimately, the risk get shared along the Wall Street, and that on that front, I think it's an improvement from what we saw back in 2008.
It's a really interesting story. Congratulations on writing this. Chen there from our New York bureau here at Bloomberg. She covers equities and arbitrage trades for Bloomberg and wrote this with a number of names that you'll know at home as well. Lu Wang, obviously the super genius who never comes on TV with us, and Justina Lee, who often does. So great job, and I'll be mailing this around to more and more people. Coming up, talks are ongoing for one of the biggest exits from a sovereign wealth fund ever, and Dani was just talking with the buyer of these assets.
I was indeed. The buyer is Brookfield. We'll have the details for you coming up next on Bloomberg Open Interest. Singapore's sovereign wealth fund, GIC, is said to be in talks to sell its stake in U.S. landlord Yes to Brookfield Asset Management. I spoke with Brookfield real estate CEO Lowell Barron back in July about their bet on the sector.
Our highest conviction is still in rental housing. There's a chronic undersupply of housing across the world. Home ownership, as you know, in the U.S. is really out of reach for most people. So people will continue to be renters for longer. Values have come down. And so we can buy at attractive values and lean into what we think is really good fundamentals.
Joining us now is Bloomberg stock market reporter Nora Melinda, who's also an expert in real estate, so the perfect person to have with us. I mean, Nora, this deal is huge. $10 billion, maybe one of the biggest for Brookfield, too?
Most definitely. I mean, this is really interesting for Brookfield, but also interesting here when we look at GIC. I mean, of course, we know this is one of the world's largest sovereign wealth funds here. And the fact that they could potentially be exiting a deal like this one, it's really interesting here, especially as you think about the fact that Yes Communities, it's actually valued at about more than $10 billion when we look at that entire portfolio here. But I mean, it's just one of the biggest exits that we're really seeing here for a sovereign wealth fund. And of course, we know that Yes Communities focuses a lot on manufactured housing, office. They have their hand in a lot of different pots here, but this could be a great deal for Brookfield, one of the biggest deals that they could have.
Yeah, first of all, it's yes!
Yes! Exclamation point, can't forget
the exclamation point is there. And
I hope the audio controlled the volume so you didn't just bleed everybody at home's ears, but yes.
And it's obviously an overseas asset, right? So How is Brookfield diversified globally?
I mean, I think that this is really interesting to think about when you do think about it on a diversification basis. I mean, we know GIC is based in Singapore. I mean, Yes Communities is based in Denver, Colorado, very interestingly. But I mean, when we think about the real estate market more broadly, what I found to be particularly interesting was the fact that Brookfield just said back in July that real estate valuations could be potentially bottoming and that there could be some sort of attractive opportunities here. So the fact that they are now exiting, or potentially exiting, we should say, because talks are still ongoing. The deal has not been finalized, but the fact that they could be potentially moving away from Yes Communities, and especially after the fact they had just kind of said that, hey, this could be a time to buy real estate.
Well, I literally just last week, just on Wednesday, I was speaking with both the Brookfield Asset Management president and the CEO of Brookfield. And both of them, either on the sidelines or on TV with me, were incredibly bullish about real estate, to your point. But there are other real estate investors, Blackstone among them, who've kind of been trying to shift away from office. And that's been kind of a selling point. You mentioned that office is part of this.
Right.
How is that specific outlook looking? Because we have seen some kind of high-profile defaults.
We're definitely seeing a bifurcation in the U.S. office market here. I mean, if you look at Park Avenue, to a lot of people's surprise, you are actually seeing an uptick in opportunities there on Park Avenue. You're seeing people actually going out, leasing some of these office buildings when you actually saw a mass exodus, of course, as we know very closely during COVID here. So, I mean, there are opportunities.
So the Third Avenue corridor is still...
It's
not
still
where
a little,
you want to own property.
Right. I mean, a little bit dicey there. But I mean, if you think about the bifurcation here, it's really about the high quality assets when it comes to office versus the lower quality assets. So you're going to see Class A buildings continuing to perform well, just even nationally. But I mean, of course, if you think about the West Coast, that's an area that still remains quite tricky.
All right. It's a very cool segment to report on. We're going to have you on more to talk about it. Nora Melinda there covers equities for us on the other side of the newsroom, but focuses in on real estate as well. Let's get a check on the markets right now as gains continue to, well, accelerate. S&P 500 trading at 66.17, up 0.5%. The NASDAQ also up more than 0.5% now at 24,234. And it's interesting, well, the 10-year coming down to almost 4 flat right now, 4.0413. We are really pushing ahead to this Fed meeting on Wednesday.
But, like, what are we trading positively on? Is that not already priced in? We know they're going to be cuts. I think Alphabet is instructive of kind of this euphoric feeling in equities. We're up 3% because Citi raised its price target because of a sell-side note, and we're at $3 trillion. It didn't take a lot to push us
It's
there.
interesting. We're not. So I look at the WRP screen to see how much is priced in terms of a rate cut. And it's still only basically one 25 basis point rate cut being priced in. But I feel like because of pressure from President Trump and because of, you know, there's just more talk about the fact that it could be 50. It could even be more than that. It doesn't seem likely from pricing, but that kind of feeling is driving momentum in this market.
That could get us going and get an expansion into other places besides tech. All right, tomorrow's show, Citi's Scott Kroner, North Star, PIMCO economist Tiffany Wild, plus the CEO of a perfume company talking about Trump's tariffs.